This one's going to be easy. This is about mining. So what we're trying to go over here is just what hash rate is. Miners are the ones that create hash rate. So what hash rate is it's the work that comes out of the ASIC server, and that's how you actually capture Bitcoin. And it's not that complicated because the machine does all the work. You don't. So what you'll learn is just basically what hash rate is, and that it is available now. Hash rate is SHA-256. What SHA-256 is an algorithm, and for all intents and purposes, it's the machine's guessing numbers. And when they guess the correct number, you capture a block. That happens every 10 minutes approximately based on the size of the market and the contribution to the market. So if there's a tremendous amount of miners pointing at Bitcoin Core software, they capture blocks maybe a little faster than every 10 minutes. And if some machines come offline, it might take a little longer, but on average, it's 144 times in a 24-hour period. So right now, the block reward is 3.125 Bitcoin. That cuts in half every 4 years. There's transaction fees on top of that. Transaction fees have been very low lately, so you can't really factor that in at this time. But basically, the amount of network contribution, which is millions of miners, determines how often the Bitcoin is distributed. And every 4 years, that block reward is cut in half. So that's how you know that there will be a mining block reward for the next 100 years, aside from transaction fees. The Coinbase is the mechanism inside of Bitcoin Core software that distributes the transactions and the block reward. Coinbase, the company, took their name from that. Bitcoin Core is the software itself. That's what the core contributors are working on, the engineers that are doing the actual software and updating and the op returns. That's Luke Dash. So hash rate distribution chart. These are mining pools. So up until now, the majority of mining is done through pools like Ocean and Brains, formerly Slush Pool. On this chart, you see that Foundry is the largest single mining pool. They have gotten a lot smaller. They've increased their fees to 2.4%. So miners pay 2.4% of what they earn to their mining pool, in this case, Foundry. And Foundry runs the software for them. They run the node, they collect the work, they distribute the reward based on your contribution. They act like a bank. FPPS is a fair price schema. And what that does is it assigns a price based on a 24-hour period to Bitcoin hash rate. So your hash rate is getting you a smooth earning. If you mine Ocean, which is not on this chart at this time, I think Ocean's currently running about 6 exahash. They've really increased. They're getting a block reward almost every day. If you mine on Ocean, you actually are mining Bitcoin and you're capturing Bitcoin from the Coinbase. There are advantages to that, and I had a hypothesis years ago, and we've seen it happen now, that AML was going to be a factor when it comes to using Bitcoin. AML is anti-money laundering, and what happens is through chain analysis, you could tell if a Bitcoin has been in a questionable wallet, if it's been in Iran, if it's been in Russia, if it's been on a wallet that may have been associated with somebody we've imposed sanctions on. That Bitcoin is a little harder to move. So to put that in perspective, recently I sent Bitcoin from a NiceHash wallet where I had some equipment running to Cash App. So I could use it from Cash App to distribute it for payments, and Cash App would not accept it. So it's something to keep in consideration when you're buying and selling Bitcoin, that not all Bitcoin is equal, unfortunately. It is non-fungible. And what that means is that if the Bitcoin has been determined to have been on FTX or Celsius, it's been involved in something that was a bankruptcy, it may not be accepted by the wallet that you're sending it to, which is why I think if you have a treasury strategy for a corporation, a sovereign wealth fund, or your own personal Bitcoin that you don't plan on using, but you're hodling it, try to get mined Bitcoin or Bitcoin with as few transactions as possible. Yes. It can. Yeah, it can. And the larger companies like Strike and Cash App, they look at the transactions that happen and they assign a report to it, and there's a specific percentage that they'll allow, there's a 10% chance this has been somewhere. Yeah, it's most people don't realize this either, but people, if you are using Bitcoin, you've seen it already. So if you sent Bitcoin to an exchange like Coinbase because you were going to use it for trading or you're going to turn it into dollars, it may not have been accepted. So I use Bitcoin a lot in my business. So I move Bitcoin every single day, multiple times a day, and I see it all the time. And it's not something to scare you because the majority of people, especially here at this conference, they're getting Bitcoin to hold. And this may be a temporary problem or it may get worse. But the Bitcoin still has value, and you can still move it into your Exodus wallet or whichever wallet you prefer. And in most cases, you can sell it to me. So, how hash rate affects earnings? Like an FPPS pool, now you could send hash rate to Kinetic. You could send it to NiceHash. NiceHash is a shitcoin company. I don't suggest you do that. But if you're a miner and you're sending your hash rate to Kinetic, you're being paid a smooth payment. It's based on your work and it's based on what the FPPS value of that Bitcoin is initially, and then demand. Demand is how we assign a premium to the hash rate. We charge the buyer who buys the hash rate a premium, and we share that premium with the miner. So something that's very relevant here is last year we mined 54 Bitcoin on our platform, and our miners made 1.5% more than if they were mining the Foundry with a 50 basis point pool fee. 50 basis points, a very low pool fee. That's the largest miners used to get that. Now they don't. It's 2.4%. They've bundled their pool with what they call OptiFleet firm management platform. And there has been an exodus. So if you actually look at the distribution chart, you'll see that Foundry has gone from 30% of the network to about 24%. They've lost like 20% of their hash rate this week because their pool fees increased on the 1st. It was not an April Fool's joke. They really did it. So with that guaranteed payment that you know you're going to get as a miner, and also capturing premium based on demand, when demand comes in, the premium goes up. We share that with the miner. Largest miners get half. Small miners get 30% of it. In almost every instance we've seen, when we audit this against every pool out there, and there's really only 3 pools. It's really Antpool, Foundry, and Brains, not counting Ocean, which is my favorite pool. But we beat them all to death, and it's going to get better for miners. Why buy hash rate? These are just questions, like, because the thought is, and I think in most cases you should not. I think in most cases you should buy Bitcoin. However, if you're a large investor and you're concerned about having Bitcoin that cannot be seized by a government or a bankruptcy judge, you might want to have Bitcoin that hasn't got transactions on it. It's virgin Bitcoin. Additionally, you could be betting because hash rate is smoother. Bitcoin price oftentimes is far more volatile. Spikes up and spikes down. Hash rate runs a little bit smoother. And if you're running a business and you have a tax burden, when you buy hash rate, you are a miner. You're leasing computers. So in that situation, there are tremendous tax advantages. I'm not a tax attorney. I'm not a CPA, but I have one. And if you're in a personal tax bracket of 37%, you could actually just kill it by buying hash rate. You're marking your own cost basis. So that's another thing to consider too. If you're mining Bitcoin on Ocean, there are days, and I've seen weeks, where you didn't get a block. In those situations, you have a complete write-off. So you have no income. When you do have income, you're assigning your cost basis on that income. So that may or may not be in your best interest, whether it's the 21% rate or the 37% rate. I am not talking about diversification because shitcoins are retarded. There are leverage strategies and there are trades that can be made with this. We are not a trading desk. We are not block fills. When you need trading, you go to block fills. But block fills can use this. And I believe that inside of strategies that are going to be done by companies like Bitnomial and block fills and Luxor, the hash rate has value. It'll push the premium up, and they'll use that to protect themselves somewhere else or to maximize an investment in some other direction. A specific strategy that I consider as a miner is the price of power. So your power costs, if you're running a large facility, it varies. You ride the real-time market typically. And there's times in the day where your power costs can be very high. It could be over $100 a megawatt hour. And there's times when it could be zero. That's usually overnight. In situations where it's high, in Texas, you run curtailment. You shut your equipment off. If you own your contracts for power, you're selling power back into the grid. You're making money at a high price. In situations like that, I believe that miners should be buying hash rate, especially if you're a public miner. You could show that your hash rate stayed the same, it stayed smooth, while you generated more revenue because you were buying hash rate. Hedging and arbitrage, we leave this up to the trading desks, but there are trades inside of here. There's trades specifically for miners. There's trades where you can look at your energy costs, look at your cost of operations, and make decisions, adding that with your ERCOT pricing, your power company pricing, your all-in pricing, and the price of hash rate. When you consider all of these things, you can make more informed decisions. So guys like Danny Goodman, that's running the trading desk at Core Scientific, he does very sophisticated strategies around the cost of power. By being able to buy and sell hash rate inside of a market, you add that component to what he's already doing, and he's going to generate more yield for his company. This is just a back of the napkin write-off on an honest man paying taxes. And I believe everybody in this room is honest, and they do pay their taxes, and they don't mind when the government earns money off of them. Another consideration, though, is privacy. When you mine your own Bitcoin, it has not been on an exchange, or it's been taken from circulation and brought back into the Coinbase and distributed. And in situations like this, where for whatever reason you don't want the exchange, or you can't access the exchange, if you buy hash rate, you could mine your own Bitcoin, put it in your own wallet, and save it forever. And it's a heck of a lot cheaper than ATMs. Typical premium on hash rate is 2%. So if you consider the cost of buying Bitcoin at spot price, it's probably right there. It's right there or slightly cheaper to buy hash rate and mine Bitcoin. When you get 50 or 75 basis point fees for buying Bitcoin, they still change the price of Bitcoin. So in almost all cases, you're spending 1 to 2% when you buy Bitcoin. Even if you're buying on massive quantities on Falcon X, you're still paying for it. If you're buying massive quantities there, or even if you're on the index with Gemini, you're still paying. So adding hash rate into the way you capture Bitcoin can, over a long enough time period, save you money and fees. Kinetic in action. This is just what it looks like if a miner is selling 20 petahash, which is about $1,000 a day, and the buyer is paying a premium for it, and Kinetic's earning $25 a day, while the miner's paying a little bit, but getting a write-off and getting virgin Bitcoin and assigning his own cost basis, and he's not dealing with that currency spread that you're getting when you go and buy and sell from an exchange. So this is 101, but advanced strategic considerations are, obviously, I've gone over curtailing ops for power. Buyers can also prepay monthly, get a discount. We would negotiate a discount with the miner. So if you're a large buyer of hash rate and you're going to invest $1 million a month or 1.5 million a month, they'll get you an exahash 24/7 for the full month. You could probably get a 2.5 to 3% discount. We typically share that discount with the buyer. That's our revenue, and the buyer saves money. And in every case, he's below spot price. The miners unlock capital. So now the miner has money up front that he could then manage with block fills or whoever his risk management and trading desk is. He could buy power. He could upgrade his equipment. There's things that can be done when you unlock money for 30 days or 90 days. An additional thing, which I talk to miners about all the time, and most are not doing this, is segregating your Bitcoin. If you're a large enough miner, or you're mining on Ocean and you're capturing Bitcoin that has 1 or 2 transactions or no transactions, it's directly from the Coinbase, put that in a separate wallet. Consider the Bitcoin that you're transacting with on a daily basis, consider keeping that in more of a hot wallet. And we do that with Strike. Strike is our payment processor, and they do custody for our Bitcoin that we have moving in and out every day. And you're a miner now. Let's get after it. Hopefully your takeaway from this is that hash rate is just another strategy that can be used to capture Bitcoin. And in some cases, depending on what you're doing with Bitcoin, it can work better for you than an exchange. If anyone's got any questions, I'm ready for them. And that's me shaking the governor's hand. I share that picture a lot. I had a little more hair. Thank you.